T.Rowe Price is down 4% over the last year and offers a dividend forward yield of 4.5%. But is this dividend aristocrat undervalued and a buy now? As usual, we're going to take a look at their top line revenue growth year on year. We'll look at their net income over the last 5 years, and we'll compare the health of the company, their total cash versus their total debt. We'll analyse how the industry and their competitors has fared over the last 5 years. We'll also see what the institutions have been doing, whether they've been buying or selling. And we'll discuss some insider selling that we do note with the vice president. And as always, we will run it through, see what that dividend safety score is, look at their financial metrics, see whether or not they are well positioned for the future. And as always, we will put them through the valuation model, getting to the intrinsic value as well as that acceptable buy price, given our investor margin of safety, and see what Wall Street are forecasting over the next 12 months. Now, jumping straight in, we can see over the last 10 years, they have been up 44.5%, but bear in mind it doesn't include those dividends reinvested, and we can see their all-time highs towards the end of 2021 at around $221. Now, it has a forward P of 15, so let's take a look. Is this undervalued? How is the company's top line? So remember, for the top line, we like to see 3 to 7% growth year on year. December 2018, 5.4 billion reported. December 22, 6.5 billion. So it's nice to see that it has grown over the last 5 years, but a few things to point out. We see some inconsistencies. The top line has grown from 2018 all the way to 2021 before dropping in 2022. And just to make clear, based on the trailing 12 months for December 23, we are expecting a drop into that year as well. So a few things to consider there. Yes, the top line is growing, but it is fairly inconsistent. Bottom line, a bit of a different story. 1.8 billion reported net income. 2022, 1.6 billion. So we can see their bottom line is actually in fact decreased over the last 5 years. But on a more granular level, we in fact see an increase from 2018 to 2021 before decreasing in 22 and then looking to be a slight bump in 23. So a few things just to think about there in terms of their income statement. Quick health check, total cash versus total debt, 1.4 billion reported in 2018, 2.6 billion in their latest quarterly report. So they are holding more cash than they did 5 years ago. Numerically and directionally then, a quick look at their total debt. Well, in fact, they had no debt in 2018, pretty outstanding. And then in their latest quarterly report, around 406 million. So we can in fact see they hold a lot more cash than they do total debt. Now, how has the industry performed as a whole over the last year? Well, we're looking at other companies in the asset management and custodial bank sector. We have State Street Corporation, Blue Owl, and a few known well others. So T.Rowe Price, total return, including those dividends reinvested, they are pretty much in the middle of their peers with a flat return over that period. When we extend that to the last 5 years, we see T.Rowe Price gone on a pretty exhilarating ride, but up only 42%, the second best performing. So again, 42% over a 5-year period for total return isn't the greatest, but it also isn't the worst. But remember, past performance isn't an indicator of future performance. Institutional ownership, well, it sits at 76%. We see around 1.7 billion worth of sales by these big institutions over the last 12 months. And in the same period, we see pretty much nearly double buying. So institutions overall are buying more T.Rowe Price quarter on quarter. And we can see Q1, Q2 and Q4 with more buying than selling for the institutions. Q3, we see a slight more sell than buy. Just a few things to consider though. It doesn't necessarily mean because institutions do, we should follow suit. In terms of insider buying and selling, well, we have looked at just over the last 3 months. And what we can in fact see is that the vice president, in fact, Higginbottom and Thompson have sold a fair amount of shares. We see over the period, now this is interesting, we see them selling a significant number, in fact around 5 to 6 million worth of shares. But this is why I always say insider selling isn't necessarily a bearish signal. They sell for many reasons, personal, financial. Just look at this column. Since they did sell, the shares have gone up between 10 to 14%. In fact, they sold around $96 to $99. So again, just something to bear in mind. Insider selling isn't typically a bearish signal. In terms of dividend safety score, well, we see that at 80 it is safe. Market cap 25 billion. We're talking about a large cap company. In terms of recessionary metrics, well, they increased the dividend during the last recession. Average growth at negative 24%, but they did trail the S&P negative 63% return versus that S&P's negative 55%. Dividend growth, very, very poor last February, 1.7%, so we are expecting an increase over the next few weeks. Remember, we want 4% or more to keep up in line with inflation. However, the last 5 years and last 20 years have been double digits, so let's hope that this does come back and we see strong increases to their dividend. And we do note they are a dividend aristocrat. They have increased those dividends for the last 25 years or more. Now, in terms of dividend yield theory, something for those new viewers, it states a company is undervalued when the current yield sits above the 5-year average. 4.42 versus 2.93, so we have our first sign of undervaluation. Forward PE pretty much sitting roughly in line with that 5-year average of 15.1, and we do note the financial sector PE is slightly lower at 11.1. Now let's take a look and see in terms of that payout ratio. As always, we do prefer to ignore the earnings. It is susceptible to manipulation by management through accounting. Free cash flow payout, you could argue below 50% for asset managers. Personally, I do have a fairly blanket rule of 60% or lower. That does give me faith that if it is below that, management can continue to offer double-digit increases. Pretty much from 2018 to 2022, below 60%. Now, this is why I say prefer look at the free cash flow. Based on 2023, the earnings is 64%. Based on the free cash flow, 114%. What this indicates is that management are expecting to pay out more in dividends than they are to generate in free cash flow in 2023. The positive here is that 2024 is expected to go back down to 60%. So maybe we don't see an overly huge dividend increase in the next few weeks. Free cash flow per share, well, 436 in 2013, pretty much doubled over the next 10 years to 939, but we do see 2023's free cash flow is expected to drop, although pick up again in 2024. Sales growth, remember, 3 to 7% is what we like to see, although we do know over the larger time period, it has been growing double digits, but please see here, 2022 and expected 2023 is expected to drop on that top line. Therefore, it has gone from around 3.5 billion to 6.5 billion, nearly doubling over the period. Not very consistent, but nonetheless, it is moving in the right direction. They've also done share buybacks, returning excess cash to investor pockets, 266 million to 225, so buying back essentially just over 10% of shares outstanding. In terms of ROIC, remember, for those that are new, I like to see 10% or more. Gives me faith management are able to effectively allocate their capital. You could argue 25% or more for asset managements. Either way, they have performed very strongly. 25% in 2022, 19% expected in 2023. I still think this is very strong for any company and especially T.Rowe Price. In terms of the operating margins, we can see here it is around that 25% level at a minimum that we'd like to see. 32% essentially in 2023. Free cash flow margin, for the majority of the years, it is above that 20% target for asset managers, although it is expected to dip slightly in 2023. No real concerns, but possibly one metric to keep your eye on. Now, as we can see, this is one of my favorite metrics for T.Rowe Price, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization. This shows us two things: dividend safety, balance sheet strength. This ultimately shows us that it wouldn't even take them one day to pay off all of their debt net of cash on hand. So they are a phenomenally strong company in relation to their balance sheet, as we did note when seeing that they had essentially very minimal debt in comparison to their cash. So let's jump into the valuation model. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. So let's jump into the first model, which is the Graham's formula. Now, for asset management companies, this isn't particularly relevant, so we will skip this one and jump straight into the first one that we will use today, the multiples valuation model. We have companies in a similar sector and size, their average P multiplied by the earnings per share to give an intrinsic value of $118. We have our first sign of undervaluation, but again, bear in mind we're not looking at any of these models in isolation. We will draw conclusions towards the end. We then have the dividend discount model where we have the yearly dividends. As we can see, the average growth rate 12%. Now, forward looking, you may be asking why have I gone much lower than the average, but we do see that very low growth rate in 2022 and 2020, or in fact 2023. 2024, I'm expecting fairly similar given how high that free cash flow payout is. Nonetheless, the intrinsic value is showing signs of undervaluation. We then get to the DCF model with the free cash flows year on year. Now forward looking, I've gone a lot more conservative at negative 1% than analyst targets. In conjunction with the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value and divide by shares outstanding. We have another sign of undervaluation. Now in today's episode, the intrinsic value is the average of these three models on screen, coming to $129. Now, as always, if you do want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio, then click on that pinned comment below, as well as if you want to join our free weekly newsletter too. So we start off with a margin of safety of 10%, which we use if we believe it has a wide moat, strong financial metrics, good forward-looking data. We can see it's a buy up to 116. Now, if we use this and put 15%, we can see it isn't too far. So right now we see around a 15% margin of safety for T.Rowe Price. Now, personally, this is one that I do hold in my portfolio with a slightly lower average cost than the current trading price. And whilst it is one I would look to add to the portfolio or add more shares of, I personally would be waiting for a larger margin of safety at around 25% at the $96, which to be honest, we have seen not too long ago. So right now with a 15% margin of safety for T.Rowe Price, we do see that Wall Street over the next 12 months do not believe there is any upside to that current trading price. Their price target is pretty much the current price that we see in the market of $110. As always though, let me know your thoughts in the comments below. Is T.Rowe Price one you like? It is a Dividend Aristocrat. They are paying a yield of around 4.5%. Or is this one you would like to get lower, or maybe for whatever reason you're not looking to touch at all? As always, if you enjoyed the episode, smash that like button. See you all on the next one, and take care as always.